There you go.
Standing by.
Welcome to the video series on tax matters as it relates to U.S. organizations, and today's topic is foreign tax credits. My name is Scott Wentz, and I'm with Montage Services, a professional service company that has offices here in the United States in San Francisco and Houston, and then outside the United States in London, Toronto, and in Germany. What we'd like to talk about today is the use of foreign tax credits and how the foreign tax credit is actually derived. It is one of the most important offsets to U.S. tax that can be used for companies that are being taxed not only in the United States, but elsewhere outside the United States. And it's not just for companies, it's also for individuals. So it applies both to individual taxation as well as corporate taxation. So why do we have a foreign tax credit? A foreign tax credit is in place to minimize double taxation. Because the U.S. imposes tax on its citizens as well as its companies on a worldwide basis, Congress recognizes that tax-paying entity or taxpayer may be double taxed. And this is one mechanism to reduce that double tax burden. So, for instance, you have a U.S. citizen who happens to also live in Germany. Because of their citizenship, they have to annually file a tax return and report their income worldwide, but they're living in Germany. Therefore, the German tax authorities charge them tax on the income they earn, most likely just in Germany, and they pay their taxes in Germany. Now they turn around and have to file their U.S. tax return. Are they going to pay double tax? No, they're going to calculate their tax, and then use this foreign tax credit to offset their U.S. tax that had already been paid on their income in Germany. The foreign tax credit is limited, and we'll talk about that limitation, and any excess can be carried forward for 10 years. There's also 1 year that could be carried back. So what is the foreign tax credit and how is it calculated? It is the lesser of two things. One is the foreign tax credit, foreign taxes actually paid in a given year, and the second is the foreign tax credit limitation, which is a fraction. I think we're all clear on what foreign taxes paid are, but just to be absolutely clear on this, it only includes taxes paid for what is known as income tax. So again, going on the German example, there might be church taxes that are paid. Those are not creditable because they're not based on income. In other countries, taxes are paid for many, many purposes. As you might imagine, there's VAT, there's value-added tax or sales tax. Those are not creditable taxes for this purpose. The other part of the limitation we said is the foreign tax credit limitation or the foreign taxes paid, the lesser of those two. So let's talk about this foreign tax credit limitation. What is it? It's a fraction of the U.S. taxes. What fraction of the U.S. taxes is it? It's the foreign source net income over the worldwide net income multiplied by the U.S. tax. So if all your income is from outside the United States, that's going to be a fraction of 1, and the limitation will be equal to your U.S. tax. But let's take a real-life example where someone has, or a company has, 60% of their income earned in the United States and 40% of their income earned outside the United States. They then allocate expenses to that income, in this case 50-50, which gives rise to a fraction of 25% of their overall income is earned from foreign sources out of their worldwide income. We then multiply that times their U.S. taxes that has been calculated. That gives rise to a $3.5 foreign tax credit limitation. We then compare that to the foreign taxes paid, and we take the lesser of those two. That is the foreign tax credit that taxpayer would be able to utilize against their U.S. taxes. Now, what's interesting is if you actually look at that calculation of the foreign tax credit limitation, you can see where the expenses or the income can deviate depending on what we call sourcing. What is foreign source income? What is foreign source expenses? And if you raise the foreign source income in this ratio, you obviously come up with a better answer in this case of more foreign tax credit limitation, which allows for more foreign taxes to be used to offset your U.S. taxes. So in looking at our sourcing rules, the income is sourced based on what type of income it is. If it's services, it's where the services are performed. For individuals, this is critical. For individuals, if you get W-2 income, or you get any kind of income, it's generally because of your performance of services. That performance of service is sourced where you physically are. So if you're spending 30 days in some country outside of the United States, and the rest of the days, usually there's 240 work days in a year, in the United States, then 30 over 240 is your foreign source ratio that you would then apply to your wages that you're reporting as foreign source. Other areas, royalties, that is where the intangibles are being used. So if a company is selling software, the foreign source revenue is where that software is being utilized. Inventory, that depends on where it's manufactured and where it's sold. Usually if it's sold in the United States but manufactured outside the United States, the ratio is 50-50 is what it defaults to. Expenses leave a lot more room for interpretation because expenses are first allocated to the source of income, and if there's no allocation that can be made, then it's apportioned based on gross to gross. Gross income, foreign to gross income worldwide. So again, expenses are first allocated and then apportioned. All this stuff adds up to reducing your U.S. tax payment. Why? Because the person or the company is already paid in another jurisdiction, and they're trying to use that payment in another jurisdiction to offset their U.S. tax. Corporations are subject to double tax, and they are allowed a deemed dividend and deemed foreign tax credit for their foreign subsidiaries. Otherwise, there would be triple tax. So the deemed credit for corporations is allowed. It's not allowed for individuals. In summary, foreign tax credits are used to eliminate double taxation. It is important to recognize that a foreign tax credit is no magic. You're still paying taxes in one country or another, and this is often a cash flow consideration. So maybe it's better not to pay tax in either jurisdiction to start with rather than worrying about foreign tax credits. But once you've moved from that, then you have to use your foreign tax credits wisely. The sourcing impacts the utilization of credits, and as we mentioned, corporations get a deemed paid credit for their foreign subsidiaries. So this topic was fairly complex, but again, if you have any questions, feel free to use us as a sounding board on those questions, and we'll get back to you in a timely manner. Now, are there any questions from the audience? Yes.
Can I combine my taxes on my investments with my taxes on my business when I determine the limitations?
They have put limitations, unfortunately, in passive income and operating income such that you have to calculate this foreign tax credit in each area. So they have what is known as baskets, the passive basket and then the active basket. Luckily, there's only 2 baskets. There used to be quite a few more, but there are still these 2 baskets that apply both to individuals and corporations such that you cannot mix the 2. Yes?
For an individual taxpayer, how are capital gains and interest and dividend income sourced?
So the question was raised for individuals, how are interest, dividends, and capital gains sourced? It's the same as with corporations. So if the interest and dividend is paid from a U.S.-based organization, that is sourced U.S. In other words, if it's a U.S. bank that's issuing the interest, then that's going to be U.S. source. U.S. company, it's going to be a U.S. dividend, source dividend. When it comes to capital gains, it is based on the residency of the taxpayer as long as a 10% tax has been paid. So if you're a taxpayer who's resident in Monaco, where there's a 0 tax rate, they will not source it foreign. However, if you're a resident in a jurisdiction that has a tax rate higher than 10%, they will source it as foreign. Good question. Thank you for listening. Appreciate your time.